Boom, boom, boom. How are you, traders? How are you? Good morning. Well, it's good afternoon, I guess, where I am. Good afternoon, good evening. Depends on where you are in the world, but welcome to another Q&A session with Oliver Velez. Of course, my name is Oliver Velez. And over the next hour or so, traders, I am going to do my best to take on your questions, and you can ask anything your heart desires. Of course, traders, I'm going to be unable to really read a lot of the questions because they come by so quickly. So if you're really intent on getting your question answered, you will likely have to answer it in a repetitive way so that I do see it. Understand also that when I take on your question, guys, sometimes I can be a bit detailed and verbose. So while I'm answering a question, I'm not looking at your questions. Um, so there might be some art involved in asking the question in a repetitive way, in a timely fashion where I see it between takes or see it between questions or what have you. Now, I'll try to do what I'm gonna, guys. I want to make you aware of the fact that I want this to become a weekly feature, and I'm actually thinking about making Monday the regular Q&A day for me. Um, so I know we obviously tomorrow's a Monday, and it won't be starting this week because I'm doing the Q&A with you now. But probably next week, I'm going to kick off this as a weekly thing so that every single Monday, let's say at 2 p.m. Eastern time or whatever time, we're gonna have a live hour-long Q&A session. And this is a way, excuse me, guys, this is a way I believe that I'll be able to put my finger on the pulse of what's grabbing you with the content on this channel. Where are there holes and gapes of knowledge and information based on your questions? So if I, for instance, get repetitive questions on a certain theme, then I know I might have to do some detailed content on that theme. Also, it's a way for us to obviously to build a deeper relationship versus it being text oriented all the time. Okay. So anyway, great guys. I know that you are coming in from all over the world. I do want you to understand that I have there are three live streams going on simultaneously. I have three YouTube channels, an English channel, the main channel. I have a Spanish language channel and a Portuguese language channel. And all three of those are live at the current moment. Okay. I also want you to be aware of the fact that there are many bots and scammers out there. I want you to understand that I will not ever text you privately out of the blue just to hold a conversation with you. So if someone's doing that with my name, it's not me. Okay. I will never ask you to send me money directly, ever. So if someone's doing that in my name, it's not me. I'm not going to randomly get in contact with you and ask you how your trading's going. All right. That is not me. And so if you're being contacted via one of my social media outlets like Instagram or Twitter or even here, it's not me. Okay. And I also encourage that you check any account that is claiming to be me and communicating with you, check their numbers. That's something that they can't fake. So if it's 10,000 followers, that's not me. All right. There's almost 250,000 people on my main page here on YouTube. On Instagram, it's almost 150,000. Twitter, 20,000. So look for robust numbers, but understand that if someone is randomly talking to you about your trading or specifically wants you to send money somewhere or give up your Bitcoin, it's not me. I would never do that in a million years. Okay. Now, also, I appreciate your support here, guys. I want you to like this video. I appreciate your comments. I appreciate your dedication here. We spend a lot of time every single day making sure something of value comes out on this channel, and many of you have shown some deep support, and it is not gone unnoticed. Okay, so couple of quick questions here. Someone was just asking me whether or not they can. I ran several special offers regarding my trading programs. Are those specials still available? Just contact someone from my staff and they will let you know. Believe it or not, I have nothing to do with the prices or anything like that. So you have to contact my staff, but there's a very good possibility that you can still be eligible for those specials. Okay. Someone was also just asking me about some new protocol with Bitcoin wallets that has been quite controversial. I'm trying to get that question here. Not sure if I can find it, but there's recently been a protocol that was introduced for Bitcoin wallets that became very controversial because it was an infringement, for the most part, many felt, on the privacy of the wallet holder. And I'm in that camp that it was not a very acceptable protocol. And so I was happy to see a wallet such as Ledger and Blue Wallet and things of that nature basically take the steps to remove that brand new protocol. So I'm in that camp. But okay, guys. So here we go. I want to see if I'm, yes, that was AOP, the protocol of AOPP. And yes, I am not in favor of that. And I would only deal with wallets who are at least have initiated the steps of removing that from their system. All right. Okay. All right. So what else here, guys? What else here? Oliver, will you be getting into algorithmic trading? Well, the answer is yes and no. I've been in algorithmic trading for, I'd say, since 2002 or so, 2002, 2003. I designed 14 individual algorithmic trading programs that literally traded 24 hours in the Forex market, but that literally traded without any human intervention. And these were 14 different trading approaches that really required a tremendous amount of manpower, a tremendous amount of constant tweaking and programming. And so I've sort of phased out of the algorithmic trading arena. Many people think that there's some superior notion to algorithmic trading, but I do want you to understand that every type of trading style, and algorithmic trading is really nothing more than a different style of market play, has its pluses and minuses. And so there's nothing overly magical about algorithmic trading other than the algorithm cannot operate outside of its protocol. So it can't operate outside of the rules that you program in it. Now, the algorithm is only as good as the programmer of the algorithm. So if the trader building the algorithm is really a horrible trader, the algorithm's going to be a horrible trader as well. And so the algorithm is only an extension of the expert behind, or the so-called expert behind the algorithm. And the very notion that an algorithm, the very idea that an algorithm cannot change is actually its strength and its Achilles heel at the same time, traders. So there is, what the human trader can do is reason between the lines, and that's what an algorithm can't do. So a a masterful trader is superior to an algorithm because it can ascertain when there is an exception to be made. So let me give you a very basic example of this. All right. I used to be a latch kid, what was called a latchkey kid back in the days, where I actually had to go home alone, walk several blocks, go home alone until my mother picked me up from the house, or on her break from her job or what have you, right? And so she would always drill me and say, Oliver, listen, don't cross the street in between. You go all the way to the corner, you wait for the light to turn green, and then you cross. I do not want you crossing in between blocks, in between cars. All right. And that's a very good rule. Don't cross in between, cross at the green, not in between. All right. There was one day I was actually coming from school and I saw a woman who had a baby in a carriage next to her car, and she had obviously gone shopping and she was taking the groceries out of the trunk. The baby was in a carriage on the sidewalk, but had started to roll down. There was a little hill, and I saw the carriage slowly rolling down the driveway, but she was in the trunk and didn't realize. I quickly dashed, not at the corner, in between. I was in between the blocks. I looked both ways, no traffic. I ran across the street and caught the carriage before it actually went into the street. She was so thankful. In fact, the woman took me home and actually wanted to thank my mom personally. Now, that was me reasoning. My mother told me, don't ever cross in between. But I made a decision. I reasoned between the lines, and I realized that in this case, this is an exception. That if I go all the way to the corner, wait for the green, cross the street, and then run back down the block, it's going to be too late. That's what an algorithm can't do. And that's what makes a human trader more superior than an algorithm. Now, an algorithm will be more superior when it comes to basically just consistently applying the trading plan or the rule. And so there's a back and forth. All right. And I actually believe that if I were to give the edge to a masterful trader versus an algorithm, I'd go with the master trader virtually every single time. All right. Now, there is a style of market play that an algorithm can do that humans can't do, and that is basically to do a micro speed trading, like tens of thousands of trades every few seconds. That is a different style of market play, and that obviously is not something that a human can do. But that's not the type of algorithmic trading that I was speaking of. All right. All right. Arhan is saying, Oliver, I heard that story before. Yes, repetition has a value, but yes, I share some of these stories with my traders. Oliver, can you please verify Cindy and her WhatsApp? Yes, Cindy is one of my staff members. And so, yes, you are speaking directly to one of my staff members if you're speaking to Cindy. Okay, let's see. What next here, guys? Oliver, is there any specific criteria? All right, this is from VJ. Is there any specific criteria of a pullback to an 8-period moving average or a 20-period moving average that you can share to take the entry, like 2 or 3 candle pullback? Thanks a lot. All right, pullback trading. Okay, pullback trading is a very fascinating form of trading. It's actually a style of trading that I recommend for traders that are having trouble catching igniting moves. And so, guys, there are 2 types of opportunities, generally speaking. There's an igniting opportunity, an opportunity that's igniting something brand new. I was just speaking about this with a group of my traders. Something that starts a brand new move, that ignites something new. That is a very opportunistic style of market play when you're identifying and exploiting igniting events. And I believe that every trader needs a small handful of igniting events that they understand what they are and know how to identify igniting events. Then there's the second category of opportunity, which is a pullback after an igniting event has occurred. So an igniting event might cause a 5-bar run up to the upside. Boom, 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 boom. And what ignited that 5-bar run is an igniting event. Okay. And I teach my traders what the igniting events are. All right. There's four main, there's 7 in total, but 4 main ones out of those 7 igniting events that typically cause multiple bar runs. And then there's the pullback events. So after this 5-bar run, being able to gauge how a stock pulls back after that 5-bar run or settles back in or rests, all right, is one of the crowning jewels of master market play, because pullbacks often lead to the secondary run in a play. And oftentimes the second run is bigger than the first run. Not all the time, but statistically speaking, the second move after an igniting move tends to be bigger and longer than the first move. Okay. And so when you're putting together an entire trading plan, your trading plan should be comprised of these two types of opportunities: capturing igniting events and also being able to read how a stock pulls back after the igniting event. Now, pullback trading is easier than igniting trading. All right. So pullback trading is easier because you already have information from the first igniting move. How powerful it was, how far did it run, what type of velocity did it take to get to its top. Now the pullback. Typically speaking, if a pullback stays in the top half of the igniting run, so let's say the igniting run is $2. If the pullback stays under $1 and the pullback is mild, meaning that there's nothing violent in the pullback, there's nothing stark, there's nothing like it's ripping through past data, it's sort of drifting back. That's a healthy pullback. The drift back is a healthy pullback. Now, oftentimes that pullback toward a 20-period moving average is going to make up your best play. Sometimes it's mild enough to react off an 8-period moving average, but the pullback to the 20-period moving average is your bread and butter play. Now, what I think the question is saying is, how do you know when to act on the pullback? Well, you act on what I call a color change. So if the pullback is made up of mostly red bars, and that's what a pullback is on the downside, you're waiting for a green bar to, boom, wipe out the high of a red bar, but not so close to the peak of the initial run. You want there to be separation from the peak. So the stock has run up, it's peaked, it's pulling back. You want some separation from the peak, right? Not so close to the peak. So the color change too close to the peak is usually a failure. You want some separation from the peak, then the color change. And that will tend to happen at or near a rising 20-period moving average if we're talking about the long side. And so you're simply looking for a color change. If that color change is happening away from the peak and that pullback before the color change, there's nothing violent in the pullback. It's more like a hang glider drifting down versus a mountain climber falling down the mountain. Falls are not pullbacks. Violent cracks are not pullbacks. Those are collapses. There's a difference between a collapse and there's a difference between a drifting pullback. So it's the drifting pullbacks that tend to ignite the secondary run, and that secondary run will tend to be longer in duration and bigger overall from a profit perspective than run number one. And so if you become a master at capturing igniting events and also being able to read which ones offer a secondary run after a healthy pullback, you've got the whole game of trading covered. There is nothing else. All trading falls under those two categories, igniting events and pullback events. Now, if igniting events are giving you trouble, then you should adopt a pullback trading strategy for a while. All right. But the true master has them both under control. All right. Good question. All right. Let's see here. What else? Can you use pivots to book profits alongside a 20 or 200 period moving average? I'm not sure what that question really means. Every trader needs a profit-taking strategy. And believe it or not, most market participants don't have a specific profit-taking strategy. They're taking profits based on a feeling, based on their emotions. They're taking profits based on profits. Like, oh my God, I've got $150 in profits. I don't want it to disappear. Let me take the profit. That's not, you can't ever become consistent taking profits that way. So you have to have your profit-taking strategy must be something written down. So for instance, one profit-taking strategy is if I buy a pullback, my profit is going to be taken once I cross to a new high. Okay, so that's a new high profit-taking strategy. All right, and to be more specific, is your new high profit-taking strategy a 1-bar profit-taking strategy or a 2-bar profit-taking strategy? As an example, do you take a profit if you have a new high profit-taking strategy? Do you take a profit on the bar that creates the new high, or do you take a profit on the second bar after the initial bar makes a new high? And so both are okay, but that's an idea. That's an example of having a specific profit-taking rule. All right, guys, the key to consistency is to be rule-based with your actions. And what you're looking to do is eliminate the possibility of trading an idea. You don't trade ideas, you trade what is. So you want to eliminate the possibility of trading an idea, trading a thought, trading a feeling, trading a belief. All right. And your plan is how you do that. So when you have this urge to take a profit, you have to go to your plan and say, wait a minute, is this my profit-taking plan? Is this my profit-taking rule? Or is this me acting on a feeling or a hunch? Because your feelings betray you, guys. Your thoughts betray you. Your belief system betrays you. And so the only way to gain consistency is to do things consistently, and feelings can never be consistent. Your feelings are different from this trade to the next trade. All right. And so everything has to be rule-based. My traders are taught 3 profit-taking rules. And whenever I catch them snatching a profit that's not one of those 3 rules, all right, they get reprimanded. Okay. And so you want to be rule-based with your profit-taking. All right. Tell us about using leverage, please. Leverage in trading, I think, is a very good thing. But it can be taken too far, like any good thing. All right. And so I do believe in using leverage for trading. But still, leverage should not be overly risky if you are operating with 2 things: a maximum loss per day that you abide by, and you take that maximum loss per day number and you divide it by 3. So let's say, for instance, you settle on a maximum loss per day of $300. I'm never going to lose more than $300 on any given day. Okay, that's your maximum loss per day. Now you're going to take that maximum loss per day and divide it by 3 to get your maximum loss per trade, which is now $100. And so now your rule book says, I'm not going to lose more than $100 on any given trade. Now apply your leverage to those numbers. And now your leverage is not risky. So for instance, if you enter into a trade with 100 shares, which is let's call 100 shares one lot. 100 shares, one lot. I enter Apple with 100 shares, one lot. Okay. My stop, I can't lose more than $100. So 100 shares means I've got $1 leeway down. So I have $1 before this 100 shares violates my maximum loss per trade. But your stop under your entry bar is 50 cents away. So now you can use leverage to go to 200 shares. If your stop is only 30 cents away, now you can use your leverage to go to 300 shares, because the 30-cent stop is still going to get you out less than your $100 loss per trade. There are too many traders that do not build their size based on their maximum loss per trade. And that's where I teach my traders where size and leverage comes into play. There are certain plays where your risk is small enough to go up in size. So smaller risk, bigger size, bigger risk, smaller size. And keep that rule in mind. All right. All right, let's see here. Okay, boom. Someone's saying, with World War III coming in the following month, 10 countries involved. Wow, that's an interesting supposition, is the definition. Which asset classes will win? Well, first of all, there are scenarios where no asset class wins. So it becomes a degree of relativity, right? So for instance, there are world events that can occur, shocks to a system that can occur where every asset gets dumped because it's a total risk-off environment. So that means your stocks, bonds, even your safety assets like gold and Bitcoin, everything can take a hit. And this is what confuses a lot of people. There are environments where nothing is safe, nothing, and cash is never safe, believe it or not. But in these relatively rare scenarios, cash becomes the go-to thing, all right, as a temporary measure. So we can have an environment where every single asset gets hit. But in that environment, what you look for is what becomes the leading horse, for lack of a better phrase, out of the dust. What rises faster, harder, and with greater velocity than every single thing else. So everything's been hit, everything is collapsed. But what starts becoming apparent as the one that's coming out of the dust and raising its head above the rest of the crowd faster, that's your go-to asset. So it's what rebounds the hardest, the fastest, the tallest, with the greatest degree of velocity. When we had the major risk-off shock to the system back in March of 2020, every asset collapsed. Gold collapsed, Bitcoin collapsed, the equity market collapsed, the bond market collapsed. I mean, freaking oil collapsed, your commodity industry collapsed, oil went negative. That's how broken the system was. How can oil be negative like it doesn't exist? It's like that's a broken system, right? So everything collapsed. But what rose, what snapped back were two primary things: Bitcoin and the equity market. They snapped back harder, faster, and with greater violence or velocity than any of the other assets. And so if you bet on those two, you were a huge winner. I mean, Bitcoin was up 900% off of that low in March of 2020 inside of a year. And the equity markets basically doubled. All right. So those were your two assets. So that's what you do in a World War III scenario. All right. But there's nothing safe when you have those things. So if you're in them, you're gonna basically be killed for a while. All right. But it's the snapback that you need to read. All right. This is a good question here. Wait a minute. Did I lose it? Okay. Does buying Bitcoin at 25,000 or 30,000 make sense? Well, okay. You're asking my opinion, and my opinion is yes. All right. Well, first of all, I think that an accumulation plan with Bitcoin is always a smart thing. But if you're specifically talking about $25,000, I think you would be getting close to what I consider to be a generational buy opportunity. And let me tell you two reasons why. Number one, what Bitcoin, I love to look at what an asset has never done. This gives me great clues. All right, listen to me carefully, traders. I love to look at what has never happened, what an asset has never done in its whole life or existence. And let me give you a couple things that Bitcoin's never done. First of all, Bitcoin has never in its entire 13-year history significantly broken its 200-week moving average. Right now, Bitcoin's 200-week moving average is around 20,000. All right, so it's never broken that. If you go back in the past and you look at every period where Bitcoin has dropped back toward its 200 weekly moving average, it was a generational buy opportunity. You got wealthy. Okay. So where is the 200 week now? Around 20,000. So where would you say a generational buy opportunity again would be? Around 20,000. Where would you say an absolute bottom would be in Bitcoin? 20,000. All right. Now you do always a range. So it starts, I would start 5,000 above. I would start 5,000 above that. So 25,000 nails that. All right. Now, what else has Bitcoin never done? It's never, in its entire 13-year history, it's never broken below its past cycle high. And so Bitcoin's last cycle high happened late 2017 when it ran from basically $200 to $20,000 and peaked at late 2017 and then went into that year and a half bear market. That was the last year's cycle, 20,000. There's that number again. So Bitcoin hasn't done two things in its entire life. It has never broken its 200 period moving average on the weekly chart, which is now at 20,000. And it's never broken its former cycle high ever, which is also 20,000, which would also mean, in my opinion, we're talking about a dual generational buy opportunity if we were to ever get down into that price area. That's, again, guys, this is not financial advice. This is more like edutainment. That is my opinion. All right. I will take this as well, guys. Look, I'm I'm amazed at how many market players don't use math, basic math in their trading. So for instance, I want you to understand that a short seller of an asset can only get 100%. And that's if the asset goes to zero. So for instance, if you want to short Bitcoin at 35,000, you get 100% win if Bitcoin goes to zero. That's it. Now, I just told you that Bitcoin did a 9x, 900% off the low in 2020. 900%. I was in it right off the low. All right. My traders were in it right off the low. So we got a 9x off the low, but you can only get a 1x if the asset goes to zero on a short. Now, that doesn't mean that shorts are not intelligent sometimes, but it does mean that you should understand that math, that you can only get a 100% gain if your asset goes to zero. Now, what's the odds of Bitcoin going from 35 to zero? I would say close to zero. So now you start going up the ladder from zero. What's the odds that it goes down to 100 from 35,000? Probably zero. 500, probably zero. 1,000, probably zero or close to it. 10,000, now we start to get off of zero. You understand? But likely, based on what I explained to you, no, not likely, not zero, but not likely. So still not a high probability trade from 35 to 10. So see how the opportunity is shrinking? So now if I told you that Bitcoin has never violated 20,000, which is a cycle high in its 200 period moving average, then so now we have, what's the probability of 35 to 20? Not extraordinarily high, but certainly not out of the ballpark, but not extraordinarily high either. So now we go to 30,000. Yeah, that's higher. But now we're talking 5,000. That can happen in a day in Bitcoin. So I'm shocked at how traders don't utilize this basic math in where are my probabilities? Are my probabilities now in Bitcoin after a 50% drop, with a probability of going to 20,000 relatively low, but going to 30,000 better, but I'm only 5,000 away? Like I say, it's better to build an accumulation on the buy side at this point, that the short play is it's too done already. The math is not there now. And it's too obvious. The market tends to undo what's obvious. All right. Bitcoin's downtrend is obvious from 69. That's the obvious play. And so I believe that the next surprise in Bitcoin is to the upside, not to the downside. But I do think that we need a flush out, though. We need one last flush out that knocks most people dead. And then that is going to be your key. Remember what I explained to you, how if an asset collapses, but comes back violently with a vengeance, that is one of your best opportunities. If it drifts back, that's not the opportunity. So you get a drop and then it drifts back. No. But if it violently rips back and undoes that drop, that's usually a major opportunity. All right. All right. Okay. How do you size Someone's asking, how do you size appropriately in day trading? And I did touch upon this. You have to size based on the part of your trading plan that details your loss. So you start off with a maximum loss per day. You divide that by 3. Give yourself 3 chances. All right. Don't utilize your whole maximum loss per day on one trade. So if your maximum loss per day is 300, you're going to divide that by 3 to get a $100 maximum loss per trade. Now, if you get into a trade that has a 10-cent stop, you can play 1,000 shares because that's going to get you $100 loss on that play. All right, so that's how you size. But if your stop is 50 cents away, you can only do 200 shares because 200 shares times a 50-cent loss is a $100 loss. You must apply size. Your plan dictates size. It should not be a random decision. Oh, I just feel like this one's a big play. Or I feel like this one's a small play. Everything should be rule-based in your trading. Consistency can only come from doing things consistently. And by, whimsically deciding randomly this trade doing this and another trade doing that is impossible to get consistent performance from that. All right. So everything has to be rule-based, and you should be able to map out a trading plan on a single piece of paper that's no longer than 10 bullet points. I believe that 10 lines, your trading plan should basically consist of 10 bullet points or 10 lines. You should be able to put that on one small piece of paper. Because if your trading plan is you're flipping pages to go through your trading plan, you've gone way off the deep end. This game is not that complex. All right. You are the complex one. The market's the simple one. All right. You bring the complexity to the market. The market's simple. It's got 3 directions: up, down, sideways. All right. That's a rudimentary, and it's neutral, meaning that it doesn't do something different for you than it does for me. So that's the tool in our toolbox, like a hammer or a saw. The market's a neutral tool. It's whose hands is the tool in that makes all the difference in the world. So you bring the complexity. All right. But so if your plan is overly complex, you're lost already. It should be a very basic 10 bullet point plan that covers these categories. Identifying what events do you identify as trades? Do you know how many traders don't know that? Like I asked them, okay, so explain to me one of your buys. What's an actual buy that if this occurs, you don't have to think, you just hit the buy button? And most traders can't even tell me what their buy is. And they said, oh, I buy when I think it's going to start going up. Like, that's not a plan. What? When you think it's going to go, when I think it's going to go up, Oliver. Would you give your money to someone would you give your family's savings to someone who says, I think it's going to go up, right? You can't trade like that, right? You've got to know this is a buy. When this happens, I don't think, I don't doubt, I don't hesitate. I don't call up the psychic hotline to determine, to get some advice. I just hit the freaking buy button every single time this happens. And you should have at least 4 of those. So what do you identify as buys? You should have at least 4. All right. You should, part of your plan should be a stop plan, your maximum loss per day, your maximum loss per trade. You should have an ad plan. There is no big trader ever that has ever walked this earth that does not add to their winning plays. Not one. And if you don't have an ad component to your trading plan, you will never be a big trader, ever. It's impossible. Every big trader knows when to add and by how much. And sometimes there is no add and sometimes there is, but you've got to know that. And that's got to be mapped out in your plan. I add under these two scenarios. What are those two scenarios? All right. My traders have two add scenarios. When any of those add scenarios happen, boom, no thinking, no doubting, no guessing, no wondering, no let me check and verify. It's boom, hit the buy button. You understand? And you should have I know how to identify my opportunities. I know my maximum loss amounts. I know when to add to every winning play. All right? I know exactly when to add and by how much. I know I have three ways that I take a profit. I take a profit under these three scenarios. And if it's not one of these three scenarios, I sit on my freaking hands. All right. And you should know how to adjust your risk. All right. So your initial stop doesn't stay. Excuse me. Your initial stop doesn't stay your initial stop throughout the whole trade. So when do you adjust that? And by how much? And those are the components of a trade. How many of you know all the components of a trade? Probably very few of you. And if you don't know how to break the components of a trade down, how to break a trade down into its components, then you can't know how to map out a trading plan, because a trading plan is dealing with each one of those components properly. And so there are millions upon millions of traders that are just randomly throwing money around in the markets. And that's what creates the markets. That's where my profitability comes from. That's where the profitability of some of my traders come from. It comes from the random group out there just throwing money around because they think it's going to go up, right? I think that's their trading plan. This is it. This is how it looks. This is how a lot of your trading plans look. I think that's it. And you can't think your way to great trading. It's just not going to happen. All right. Right. Okay. I would like to, Oliver, I would like to work for you as a Latam staff member. What can I do? You can send a resume. I guess it's not called a resume, maybe where you're from. I forget what it's called, but to info@ifundtraders.com. And if it's interesting enough, my staff might give you a call. It's guys, believe it or not, I stay out of those things. I'm a trader. I hire people to run certain aspects of things, and I just stay out of it. I'm a trader. I know my limitations. You know? All right. What else here? What else here can I answer? Rajesh, I see your question. You are definitely asking it a lot. I just don't understand it. But I do see your question. Something regarding the open high-low. Rephrase it. Try to make it clearer for me. All right? Now let me see this. Oliver. Okay, the boss. Oliver, what do you think was the specific detail, that exact turning point with which you went from being a losing trader or being in break even to becoming a winning trader? What was the moment? Interesting question. I believe that traders fall into one of two categories when it comes to the transition from loser to winner. And I consider break even a winning trader, by the way. All right. So I'm including break even trading in the winning camp, because if you can go into the most competitive market in the world and pit yourself against some of the brightest minds, some of which are sloshing around billions of dollars. If you can go into that shark infested pool with your money and come out with your money, with your limbs intact, your arms, your legs, you've got your pants still on, your underwear, your shirt. They didn't rob you. They didn't take anything from you. Oh my God, congratulations. That's a win. All right. Because it's shark infested. So you have won. You're a winning trader if you're a break-even trader. Congratulate yourself. Okay. Now, I believe that traders fall into two general categories when it comes to making that transition. One is what happened. One is where you start to see glimpses of who you're going to be in the future. So you're really bad. You're really bad. You're hemorrhaging money. You're really bad. But you start to see moments of goodness. And you're like, whoa, I did really well these last 2 days. And then boom, it'll disappear and you go back to being bad. Bad, bad, bad. But then again, there'll be, wow, on this day, I did almost every single thing perfectly. And boom, it'll disappear. Now, that type of trader will gradually, if they apply themselves, the gap between the good periods starts to get smaller. And the duration of the good period starts to get longer. So maybe in the past, the good periods, maybe they had, the good periods lasted on average 2 days. So I can't get past 2 good days. All right. And that happens once a month. So they've got the duration of good periods, 2 days, and the frequency is once a month. Now they get duration of 2 days, but it's happening now 3 times a month. Better. Now they're stretching their good periods. They get 3-4 days sometimes. And that's happening 4 times a month. And now they get a week. They can put a solid week of good trading in. So this is the gradual turn that tends to happen with some traders. Those bright days get longer and the dark periods get shorter until there's more light than darkness. Okay? Then there's the category that I was in. And to be honest with you, I don't wish this category on you, but you might be in that category. And that is the category where there is no light. You almost never see light. There are no 2 days. There's just losing day after losing day after losing day, to the point where you think, like, how can someone be this bad at something? How can I break mathematical law? I mean, if you flip a freaking coin long enough, you get practically 50% heads and 50% tails. I can't even do that. I can't even flip a coin and win sometimes. How can someone lose 100% of the time? How can I be this bad? That category is the category that I was in. It was so sad that sometimes I would crack up just because I was in disbelief. You know how like the Joker crack? Like I would just start hysterically laughing because all I could do is cry. And there are some traders that fall into that group where you don't see any light whatsoever until one magical day. I am telling you, traders, it happened in one day. I remember it like it was yesterday. I mean, for some reason, this day just seemed different from the moment I woke up. There was a different feeling. Colors were brighter. I don't know. It was just the air seemed different. And from that day, everything changed. everything. Now, I'm not saying I went from chronically losing every day to being a multi-million-dollar trader. No, but markedly better in one day. Now, from the outside and looking at my record, it would appear as though it was almost like a magical event. That Oliver went from 0 to 100 in an instant. But no, there was growth happening all the while, but underneath. It wasn't visible. You can actually be getting better, but your record can show that you're actually worse. And a lot of people don't understand this in trading, and it's when they quit and maybe even start to call the whole activity a scam, because how can they ask themselves, how can I be getting better? How can I be getting more educated? How can I be getting more trained? How can I be getting more disciplined? And my record shows that I'm actually dumber than I was when I knew nothing. How can I make more money when I knew nothing and lose more money when I know everything? And this is a normal occurrence, guys. That strange dichotomy, that strange, weird period where you know you're smarter, you know you're more skilled, but your account is in a straight downtrend. You're in an uptrend and your account's in a downtrend. How can that be? And that's what I experienced. And what I realized looking back is that I was so deep that I couldn't see the turn back to the upside. So the turn back to the upside was happening, but it was coming from so deeply below break even, below the light, as it were, that you can't see the movement back up until it breaks. And that break into the light is really appears like it's one day. Like, how did that happen? But you were rising in the darkness underneath, but it just wasn't perceptible to the eye for a long period of time. And so when I tell my traders that you're going to fall either in one of these groups, they instantly want to know, well, Oliver, what's the best group? What's the best way? I believe the best way is not that way, not the way that happened to me. I believe the best way is to see glimpses of yourself. There's more hope in that approach. When you see breakthroughs, they might disappear and come and go. That's normal. But at least you see glimpses of what is to come, and it keeps you in the game longer. And I believe that those who fall in my category, that category has the greatest degree. That cemetery in that category is much larger. There's greater deaths in the darkness category versus the periodic light category. So if I can wish one on you, I'd wish the periodic light category. But you might just be in the darkness category. And I don't know this for sure, but I don't think you can choose. I don't think you can choose which one you are, because a part of trading, guys, your path is largely determined by what you bring to the market. This is why the journey is so personal. What baggage do you bring? Because your baggage is going to be different from another trader's baggage. This baggage you have to deal with and get rid of. But you don't want to get rid of the baggage. It's your baggage. It's part of your identity. But the market is going to demand that you get rid of this baggage. But some of you are going to feel like it's Louis Vuitton luggage. I invested a lot into this luggage, this baggage. And the market's going to say, get rid of that. That's nonsense. And you're going to struggle to, and then another trader brings a little duffel bag to the market. And they're going to have to get rid of that. But getting rid of a duffel bag versus a 14-piece Louis Vuitton luggage set and two different things. And so your path is largely determined by who you are, what you bring to the market. You know, whether you have a propensity to be disciplined, you know, whether you are someone who really you struggle to win every argument. You know, that's a trait that's going to spill over into your trading, good or bad. Whether you have won, whether you're used to winning in your life, all right, which is usually, when it comes to trading, a negative, believe it or not. The person who's used to winning in life is going to be broken down by the market, because this is not a game of winning. It's a game of how to lose properly. And a lot of traders fail to realize that. You lose your way to success in this game. You don't win your way to winning. You lose your way to winning. All right. It's through the process of negation that you become successful. It's through the process of learning what not to do so that whatever's left is what you should be doing. You can't go directly to doing what you should do without removing what you shouldn't do first. So everything is backwards. You learn to lose properly. And by learning to lose properly, all of a sudden you look, oh my God, I'm profitable. Look at that. I wasn't even trying to be profitable. I was just trying to lose properly. And all of a sudden the profit started appearing. That's how you become successful as a trader. You don't try to win. You'll never get this if you're trying to win. You've got to try to do the right thing from the loss side. The winning side takes care of itself, traders. What do you do if you buy a stock and it goes up $2? What did you do except pray? You didn't call up your billionaire friends and say, guys, I just bought. Can you throw a couple $1 billion now into the stock to push it up $2? You didn't do that. You didn't physically push the stock up $2. You did nothing but pray. So the market didn't need you to do a $2 move. But if you have a maximum loss of 100 and you buy your stock and you eliminate that stock at a $90 loss, and now it's down $2, which would have been a $200 loss. What did you do? Because if you did nothing, you would have a $200 loss. You did something to make it a $90 loss. You see? So your job is not on the winning side because you don't do anything. Your job is to make sure the losing side is handled correctly, and the market's job is to handle the winning side. It's a partnership, but there are far too many of you trying to do the market's job, and you're leaving your post. You're leaving your job untouched, unfocused. You lose your way to winning. You must lose your life to gain your life first. You always deal with the loss side. You must squat before you leap. You must pull a bow back before it springs forward. You focus on losses before you can become a winner. Everything in life is that way. But no. You know what you guys want to do? You want to not deal with the losses. You just want to focus on trying to be a good winner. That is not your job. And this is what extends the journey for so many traders. They don't need to be that long on the path of trying to become consistent, but they extend their journey by focusing on the wrong thing. And this is where a mentor or someone who's gone down the path that knows all the dead ends that can prevent you from, that's the value of where that comes from. All right. Anyway, I know I've gone off on a tangent for that, but that's just a great topic that, a lot more people need to become aware of. Hi, boss. Do you believe the U.S. will ban Bitcoin in the future? First of all, Bitcoin cannot be banned. I just want you to understand that. It is not bannable. Now, what can be banned are the on-ramps to Bitcoin, meaning like Coinbase is a way, an on-ramp to get Bitcoin. So those can be regulated. Bitcoin can't be regulated. On-ramps can be banned. Bitcoin can't be banned. Its citizens can be regulated as well. Bitcoin cannot be regulated or banned. It's very important to understand. All right. Now, what's the likelihood of that happening? I say that we're pretty much close to zero of that happening. You have companies that are going public in this space every single day, regulated companies going public. There are billions of dollars of value in the Coinbases of the world. And the miners, Bitcoin miners are going, there's 34 public miners now, regulated, publicly traded companies now. If there was an idea to ban Bitcoin, if there was any notion by the U.S. government to ban it, this would just simply not be allowed. Bitcoin is legally designated as property in the United States since 2014. You have more and more, Bitcoin's becoming more and more of a bipartisan political talking point today, where you have mayors, you have senators, or what have you, now becoming Bitcoin oriented, having Bitcoin oriented platforms. There are cities now and states seeking to make Bitcoin legal tender. We're way past, guys, this idea that Bitcoin can be banned or is going to be banned. First, it can't be. I think it's the opposite. I think that what is happening and what will continue to happen and what will continue to accelerate is that there will be more embracing. I also think there's a hidden race to gain as much hash power, Bitcoin's hash power in a country as possible. And I think that America is secretly doing what it needs to do to make sure hash power, right, the computing power behind Bitcoin's mining, is predominantly in the United States. It was in China. China banned the miners. Most of those miners found their way to the United States. The other portion found their way to Kazakhstan. Then all of a sudden, right, people who don't even know where Kazakhstan is, never heard the word before, all of a sudden became aware that there's a Kazakhstan who gets his internet taken off. And then the second largest Bitcoin mining hash rate area goes down. So America becomes number one, Kazakhstan number two, and all of a sudden Kazakhstan goes down, and a big chunk of those miners go where? The United States. And the ones that haven't yet are actually in talks to go to the United States. So I don't think that these things are by chance, right? This is too big for anything to be by chance. Why is America accumulating Bitcoin's hash rate power? And is it by mistake? I don't think it's by mistake. So I think it's just the opposite of banning. I think the U.S. ultimately, while not openly, verbally yet, ultimately wants to embrace it. And let's think about this, guys. Bitcoin overall is an American technology. I mean, a lot of people don't like me saying this. I'm not saying that Bitcoin itself is American, but the components of Bitcoin are American. From cryptography is an American technology, right? I'm going blank here, but the 256 bit encryption, that's American technology. All right, so most of the components that have basically made this special asset are American in nature. So anyway, I just think that we're past banning, guys. We're way past that. How do you decide your weekly maximum loss? Thanks a lot. Good question. All right. So I would say that it should be based on your overall account size. And that in includes leverage. So you take your total leveraged amount, right? And you do something like you don't want to lose, let's say you don't want to lose more than 2 to 5% of your total leveraged amount. All right? So math can work in that range. All right? So for instance, if you've got $100,000 in buying power, you should not want to ever lose more than $5,000. But then that's too sizable as well. I would say you would never want to lose more than 2,000. And so if you were to break that down into 3 parts, then you'd get your maximum loss per trade. All right. If your account's big enough, you can go as small as a 1%. So you take that 1% number of a big account, you divide that 1% number into 3 parts and get your maximum loss per trade. All right. But it should include buying power. All right. What else? I'll take a few more, guys, and then we're going to go. I don't want to keep these too long, but we'll have these regularly. Oliver, do you simply use only the 2 moving averages that I always see on your charts and those 3 types of bars? No. There are 5 dominant moving averages. The 2 moving averages you hear me speak about the most here on YouTube are the most dominant of the 5. So, but there are 5 dominant moving averages. And yes, there are more than 2 bar types or 3 bar types, right? There are basically 7, guys, there are 7 events on the buy side, 7 major events on the buy side, 7 major events on the sell side. All right. So in total, there are 14 actionable events. Now, if you don't know what your events are, you're lost from the start. All right. If you don't know what defines an event for you, where it's an unquestionable event, when you see this event, there's no doubt, you just hit the button. All right. And so I teach 7 on the buy side, 7 on the sell side, or 7 on the short side. All right. And so, there are 7 items. And you don't really need much more than that. I think that most traders are trying to do too much as well. There's an element of specialization that should come into play in your trading. You should specialize in 1 to 2 things. That every trader needs a specialty. What are you the best at? What are you good at? All right. And so I tell my traders, out of these 7 actionable events, you should keep records as to which one rewards you the most. All right. If you were to put all 7 actionable events in a race, which one produces the most money? Which one produces the smallest losses? Which one produces the greatest consistency? And you'd pick the top 2 and become a specialist there. And you take the bottom 2 and you drop those for a while. It's it's easier. Excuse me, guys. It's easier. It's 3 times easier to accentuate what you're good at than to fix what you're bad at. Now, you always have to keep losses contained, but sometimes just not doing what you're bad at fixes a whole lot, guys. And I see a bunch of traders just working on what they're bad at. And I say, well, why would you waste time on that? Tell me what you're good at, and let's throw that energy into what you're good at, and let's forget what you're bad at. I get traders that struggle with a stock, right? So I ask a bunch of traders, what's your favorite stock to trade? And you know what? Half of them Whatever group I ask, half of them, their favorite stock is the stock they lose the most money in. Like, really? Like, how does that make sense? And half of them, half of that group doesn't even know that that's the stock that they lose the most money in. So I have my traders run a report. We run a report periodically that is P&L by symbol. And I want them to be aware of which symbol, which stock is delivering the biggest gains for you in the greatest consistency, and which stock is delivering the biggest losses and the most frequent losses. And so let's eliminate the bottom and let's accentuate the top. Whatever trade you were dedicating to the losing symbol, throw that effort and that money into the top. Sometimes, guys, a fix is just as simple as stop doing it. All right, Oliver, I have this excruciating pain in my head. Every single time I bang my head up against the wall. So what's your advice for me? Stop that. Don't do that. And you'd be surprised how many times that's the answer in your trading. Oliver, I'm losing every single time. Oliver, I know your elephant bar concept. I lose almost every single time that I do the elephant bar concept. Okay, don't do that. That's the one not for you. It's not the only thing. All right. And so sometimes it's just stop it. That's the answer to a lot. Stop. Don't do that. Stop trading that stop. Oliver, every single time I add 3 times, I lose the biggest. Stop adding 3 times. Every time I trade this stock, I don't know what it is, man. It's like it doesn't like me. Stop trading that stock. Every time I do elephant bars, stop trading elephant bars. And then you get to what you should accentuate, right? It's true, man. Most of the time when a trader is asking me a question about something, they're seeking a solution. The solution is in the question. Oliver, you teach us how to buy climactic drops off the bottom. You teach us that strategy, the climactic buy strategy. It's picking that moment that you have that climax down and then whip back to the upside. You teach us how to catch that. I just lose with it all the time. Don't do that one. That's not for you right now. We can come back to it later. But right now, the solution is in their question. Stop it. All right, Oliver, do you use market orders? No, I don't think I have ever placed a market order ever in my life. I don't even know how to do them. How do you do a market order? I wouldn't even know how to do one. No, guys, I don't do market orders. And let me just tell you where that comes from. I used to take advantage of market orders when I was a market maker. All right. So the market orders were gifts to us. And a lot of them came on like earnings and stuff like that. You'd get this proliferation of market orders before the market opened. So let's say I'm a market maker in Apple, as an example. And all of a sudden, I get this proliferation of the market hasn't even opened yet. And this proliferation of buy at the open, buy market order at the open. So the order's just waiting there. That basically tells me I can execute this anywhere? Really? They're giving me the freedom to execute it Anywhere? Well, you're going to get robbed a little bit. You're not going to get the best price. So today it's certainly gotten a little bit different because when I first started trading, guys, your average spread on a NASDAQ stock was $4. Think about that. The average spread. So you had some spreads that were $10, $8. The average spread between the bid-ask spread was $4 when I first started trading on NASDAQ. So yeah, you had stocks that had spreads of $1.75, but those are the really tight ones, right? And I was a market maker for a stock called Microtouch Mitzi, and I had a that stock had an average spread of $4.50 or so. And sometimes it would go to $8 in highly volatile areas. And so when you're applying market orders in that environment, you're just going to get really killed. Now, because of decimalization and greater velocity and the ability to trade between pennies, it's added a higher degree of liquidity at every single price level. And so market orders aren't as bad as they used to be, but still, I just don't use them. All right. I place limit orders, and if I don't get that, I go for the next price. I go for the next price until I get it or until I say I missed it. Oliver Velez, do you do options trading? I used to be a fairly sizable options trader, guys. Not so much now. I use it mostly to hedge my wealth positions, but from a day trading perspective, no, I don't. I believe that options from a day trading perspective is extraordinarily hard. So if trading equities themselves from a day trading perspective has a 92% failure rate, and it does, trading options will be close to 98 and something, a 98% failure rate. Day trading options, you're adding a higher level of complexity and difficulty to an already difficult equation. So trading the underlying item has a 92% failure rate. So imagine trading a derivative of the underlying item, how you're now more complex because you're one removed from the actual item itself, which is not going to move all the time the same way the item. So just imagine how you've upped your failure rate. All right. So I just think that your higher success rate with options goes with a longer term view. The other thing with options is that most people approach options like a poor man's racetrack, right? So they play cheaply. They think that options are good because it allows you to play cheaply, but that is the trap. The trap is to cheaply take your money in a game where the odds are tremendously against you. And you will last longer if I take your money from you in smaller chunks. If I take it too aggressively from you, you might quit before I can get the majority of your account, right? But if I can nibble away at your account, I can eventually get all of it. And that's what the options game is designed to do when you play short term and you play cheaply. The best way to play options, number one, is to be a seller of options the majority of the time. Most individuals are buyer of options, but the best odds are on the sell side of options. You sell options or write options, right? Most of the time. In addition to that, most of your better options are the expensive ones. So you up the odds by not day trading and going for wider periods. You up the odds again by not playing the cheap options, but playing the more expensive options. And then you up the odds even more by writing most of the time or selling options, not buying them. Options are a game of hope. Do you want to sell hope to someone else? Or would you rather be the buyer of hope? Do you understand what I'm saying, guys? Does this make sense? You give me that choice, I will sell hope every single day of the week and twice on Sunday. So options is a game of selling hope. And that's how you increase your odds of winning. Yes, right. That's right. XSS. Selling options makes you money more than buying them. Absolutely. All right, good job. Good. How do you hunt or pick stocks? This is from Pradeep. This is a good question here. This is something that I'm a stickler for with my traders. I don't want you to be a hunter. I don't want you being a searcher. Novices search. Novices hunt. Novices look for opportunity. Where is an opportunity? Is it over here? Is it over here? That's a novice. When I see a novice scanning, I'm scanning the novice, right? I'm looking for where the next opportunity, novice. All right. Where's the action today? Novice. The professional does not search. Do you understand? The professional waits. There's a very big difference. The professional never leaves his post. So I teach my traders that if this is the event that you play on the long side every single time, right? Then you must sit here and wait for this event to happen to you. Do not look over there for this event. Do not look over there for this event. You wait for this event to come right here in your freaking face right here. So if Apple is one of the stocks you trade, you sit with Apple and you wait for this to happen to Apple. You see, every stock gets their chance to have this event. Don't search for it somewhere else. Sit here and wait for this event to form right in your face and then do it. And I tell the traders that think of a New York Stock Exchange specialist. Some of you have seen pictures or movies or seen it on the news, the floor of the New York Stock Exchange. Every New York Stock Exchange traded stock has a specialist that sits in a pit. So let's say it's the Disney pit. So there's a specialist that manages the Disney book. That's the New York Stock Exchange Disney specialist. That trader is responsible for running the Disney book, right? Which is an ancient form of trading. It should go away, but it's still the case. So this one trader trades one stock and sits there in the pit. Now, sometimes the action is at another pit. Sometimes the action is, let's say, in the Twitter pit, all right? Because maybe there's some news story and the crowd is over there. Does the Disney guy leave his pit and go to the Twitter pit? No. That guy knows that the crowd comes. There are times when it's the action is in Disney and the crowd's here. I sit in my pit and I wait for the crowd to come to me. And that's the ultimate professional is a specialist. So do you want to be, so the average novice losing trader is in Facebook groups and Twitter groups and Telegram groups with a bunch of people trading random things they've never heard of before because enough people are now talking about it. They're on Reddit, and because enough people are talking about this symbol, they go over there. Then they talk about that symbol and they go over there and they go over here, and they're all over the place. So that's the opposite end of the New York Stock Exchange specialist who trades one thing and sits in his pit and waits, versus the opposite end. I'll trade anything that has action. All right. Where do you want to be closer to? The New York Stock Exchange specialist or the Reddit trader, right? You want to be closer to, I trade a small number of things, not anything, a small number of things, and I sit with this small number of things and I wait for this to happen in any one of them. I wrote something many years ago in my first book, and it has caught the attention. It always catches the attention of a lot of people. And it is this: when you get good, you don't choose your trades. Your trades choose you. And when you make that transition, you're a master. Your trades should be choosing you. You should sit and have your 6, 7, 8, no more than 10 stocks in front of you. And they should be vying to choose you. One of them will step up to the plate, and that one is delivering this. And that's the one you play. On another occasion, another stock will deliver this. And then that's the one you play. It's choosing you. You're not randomly saying, I think I'll trade that one. Oh, I think I'll trade that one. No, it's whichever stock delivers this to you, boom. And so this activity should not even be called trading. It should be called waiting. The name is wrong. You're a waiter, right? You wait for your item to happen to you. You're a waiter, not a trader. All right, traders, good. I'm sorry I couldn't get to all of your questions, but we're going to do this once a week from now on, okay? So be on the lookout, not this upcoming Monday because I did the Q&A session today. I'm going to come back the following Monday, and I'm going to try to do my best to make it every single Monday at the same time so that you know it's like a program, okay? I want you to know I love you to death. Thank you so much for your support, guys. Thank you for being here. I love reading your comments on the videos. It helps me also to know what type of content I should be putting out next. So please keep your comments. If you have not subscribed, hit the subscribe button. Make sure you click the bell in the upper right-hand corner to check all notifications so that you never miss a single item here, guys. I made a promise a very long time ago that every single time I given the opportunity to speak in front of a mic to an audience, I would do my best to deliver something of value. I hope that I've done that here today with you. And I will continue. And if I haven't, I will continue to improve. I promise you. All right. Ciao for now. Enjoy the rest of your Sunday. And we're back at this game tomorrow. Boom. Nice. Ciao. Ciao, guys.